Last month's G20 summit in Australia came and went without the protests and riots we've come to expect at the summit in recent years. But as author and researcher Ellen Brown notes, the real fireworks happened behind closed doors, where the group rubber-stamped new regulations that will make Cyprus-style bank bail-ins a worldwide reality. This is the GRTV feature interview with Ellen Brown and your host, James Corbett. All right, Ellen Brown, let's talk about a series of articles that you've been writing recently that I think are extremely important on the subject of banking regulation. And this, we can pick this story up at the recent G20 meeting, which really didn't create much of a splash in either the mainstream or the alternative media, generally speaking. But there was an important rubber stamping of a piece of, a white paper regulation proposal by a shadowy body known as the Financial Stability Board that very, very few people have ever heard of, but is quietly rewriting the architecture, the infrastructure for global banking regulations behind the scenes. And you start by noting this in an article that I'll refer readers to called New G20 Rules, Cyprus-Style Bail-ins to Hit Depositors and Pensioners. And this is a very important subject, but one that unfortunately it's difficult for a lot of people to wrap their minds around because there's a lot of jargon here, including a white paper from the Financial Stability Board that we'll link to called The Adequacy of Loss-Absorbing Capacity of Global Systemically Important Banks in Resolution, which I defy you to say 10 times quickly in a row. But at any rate, these are the types of rules that are really going to have a significant effect on us. I'm sure the audience is by now very familiar with the idea of banking bailouts as what we saw in the 2008 crisis. But in the event of the next crisis, we may be looking at a bail-in scenario, similar to what happened in Cyprus last year. For people who are not familiar with the idea of bail-in, perhaps you can walk us through that and what that actually means in the event of the next global systemic banking collapse.
Well, after the last one, governments balked at bailing out their big banks again. And so, for example, in the U.S., the Dodd-Frank Act said no more bailouts. Of course, they just now changed that, but that's what it said. And so but it didn't say that we're going to just let these banks go bankrupt. It said there's going to be a new way of doing it. You, the banks, are going to have to figure out how to recapitalize yourselves. And so we want to see you come up with living wills. These are like zombie banks coming up with living wills for what they're going to do in the event that they're about to expire. And what they're actually told to do is to confiscate the assets of their creditors. And this would be their shareholders, their bondholders, and their depositors, which is the largest class of creditor of any bank. Now, theoretically, we're protected by depositor insurance. In the U.S., it would be FDIC insurance, but the FDIC fund, and that, first of all, that only goes up to $250,000. So the people who aren't covered would be businesses, for example, who keep a lot of money. They need a lot of money for their cash flow. They have to pay their payroll and so forth. And in Cyprus, for example, everybody over the deposit limit, which in the Eurozone is 100,000 euros, lost 50, I guess in the end, they lost about 50% of what they had in the bank. Well, that was a huge hit. And these were mostly businesses, local businesses. So that means they wind up either closing their doors or laying off their employees. So everybody basically got hit. The whole economy got hit. And that's what we'd be looking at as well. I've seen that they're now telling their large depositors, pull your money out of the bank because we don't want it anymore. So now where are they going to go with their money? Of course, my thing is public banking. I think we have to set up our own publicly owned banks. So anyway, the people under $250,000, which would be most of us, are supposedly covered by this FDIC fund, which currently, last time I looked, had $46 billion in it. The problem is that there are $4.5 trillion or so of deposits that are covered by that $46 billion. That's like half of all the deposits, which are close to $10 trillion. So obviously there's not enough money to cover all the deposits. Theoretically, the FDIC has a $500 billion credit line with the Treasury. But first of all, they have to pay that money back. They're supposed to give this a payment schedule and show how they're going to pay it back. who's going to pay it back? It's supposed to be their members who pay premiums, and the last time they had to pay back much, much less, just like a few billion. It was very hard on the small banks, and many of the small banks then wound up either going under or selling out to the larger banks. So they would never be able to bail out a JP Morgan or a Bank of America, which both have over $1 trillion in deposits. But the big liability is their derivatives. They have there are 280 trillion in derivatives that's the exposure of the U.S. banks. There are 6 big banks that are there, or 5 or 6 big banks that are the big derivatives banks. And so JP Morgan, for example, both JP Morgan and Bank of America have over 50 trillion in derivatives. So if they get hit with something unexpected, a big derivatives loss, then it could well wipe out their deposits. And the problem is that under the Bankruptcy Reform Act of 2005, the derivatives players go first in bankruptcy. So they get to snatch all the collateral before the FDIC even gets in there, or the state and local governments who they theoretically are secured with collateral, but so are the derivatives players, and they're the ones that get to go first. So they're going to take all the money. And right now, what we're looking at, and why I think there's all this haste to change the rules again, is the collapse in the price of oil, which has gone down by about 50. It's gone down by half, which nobody anticipated, and it's not within. Of course, the banks plan for it. They hedge and they plan for all these things when they do their derivatives, but nobody planned for that because it simply was not the result of supply and demand. There's pretty good evidence that it's actually geopolitical warfare.